And I think a lot of the use cases that we've seen in the market to date have really been on sort of a one-off basis. It's an issuer going to their regulator saying, we want to do this. Are you okay with it? Yes, we can move forward. And they'll then ultimately go on and tokenize, but there's not much that's happening beyond really the tokenization of that asset.
Specifically around the issue of what's a security and what's not, there's a well trodden Howey test. The definition or analysis of the Howey test is very murky. You can go to a law firm and they're going to tell you, here are the 5 reasons why it may be a security, and here are the 5 reasons why it may not be. And it's up to you to choose where your risk appetite is. So while there is some guidance in the US around specifically securities, I think we still have a great need for much greater clarity around how this industry is going to evolve before you get the issuers really comfortable, as well as some of the large organizations, global custodians, et cetera, that gain the comfort of actually moving forward in a meaningful way in this area.
Institutions have to realize the first steps are just a pain in the neck, right? You do the first couple of issues, it's extra. It's money in another place, it's assets in another place. You've got to have some conviction over more than just a 2-year period. So all of us, as we do all these things, we're always fighting the fact that in some business, in some of the banks, somebody's just deciding, well, it's not going to help me in the next 2 years, so why should I care? Which is a problem not just for digital assets, but it's a general one right across the board. So you need some high-level sponsorship for the banks to say, hey, let's do these first issues, we'll do the second issues, third issues, and bring that along. Just Switzerland compared to the US, for example, very nice, certain regulatory regime, can issue securities tokens, that's not a problem. But now you need all the banks to play along and process the stuff, and that's always a challenge, herding those cats.
We don't really have clear regulatory framework and structure around it that can then give guidance to the infrastructure providers. So if we talk about brokers, exchanges, investors, how do we then manage, custody, settle these assets once they're tokenized? In the US, I think we all kind of see what's happening here. Different regulatory bodies feel different ways about different types of digital assets. And so I think we really need to get some consistency out there, both in the US as well as abroad, so that we can really drive liquidity and adoption within this market.
I think the guidance, or lack of guidance rather, is also affecting the issuer appetite, is a lack of regulatory clarity. And I think we get more clarity there, you're going to see a pretty quick adoption curve.
Moving ecosystems needs coordination, and there are overheads for coordination. So everybody jumps onto the regulatory clarity, because that is one thing that can give a push in equal terms to everybody in the ecosystem.
We just recently surveyed about 25 of the leading European and actually US banks who have operations in Europe just on this whole topic. And I would say 3/4 of them felt that, this tokenization, security tokenization, presents a very significant opportunity in the medium term. However, majority of them are not doing anything to realize that, in the plans in the next 2 to 3 years. When we asked them why that was the case, I mean, the biggest barrier came back to this regulatory uncertainty point. And actually, one of the interesting points that came out of that was actually a desire for much better kind of global coordination around regulation.
I also think that it's going to be some kind of regulatory collaboration that needs to kick in for this to happen. We are far more globalized today than, let's say, 20 or 30 years ago. So in order for these things to scale globally, there needs to be some kind of a regulatory coordination that needs to happen, especially in this space. And that kind of collaboration also would sort of aid tokenization standards to come through, and that's also another other thing that would help develop this particular ecosystem. Right today, you have a lot of choices if you want to just go out there and issue tokens, but how should these things interoperate across boundaries? Those kind of things are also holding the adoption back.
I think 3-4 years ago, the answer would have ranked a lack of institutional grade infrastructure among the top factors. And I think infrastructure has actually come a long way in the last 2 or 3 years, and is now really leading the pack in terms of giving a pathway towards future tokenization.
Is definitely the privately managed illiquid asset classes where, which are being chased. And right now, there's huge swath of investor base that does not have access to it just because of the minimum ticket sizes. That's an attractive use case. The second, though, which I think will basically drive the market, would be the non-fungible collectible token market. So that's where, if you basically look at these two asset classes and ask yourself, which is likely to basically move forward and where democratization will hit. And today we are seeing NFT market basically moving much faster. And that will potentially give the other illiquid asset classes the potential of what can happen when you bring down, right? So and that is what I think potentially the trigger for the traditional either private or public securities market to sort of move along the line. But I do think new asset classes might lead the way here.
We've seen a lot of use cases around real estate bonds and things of that nature that are difficult to get access to because of the minimum ticket sizes that we have today.
The three asset classes that they called out as kind of top of their list was debt, real estate, and the liquid asset. And that's why I think things like collectibles, art, etc., are kind of really interesting areas.
Small or medium-sized enterprises probably need debt before they need equity. And there's a demand side. The banks are a little restricted with their balance sheets with impending Basel IV. The old ring up the bank, increase the loan or line of credit is probably a route that's needs to get replaced.
If we even take a step back from just the tokenization specifically and looking at, well, what is the opportunity beyond that next phase or evolution of tokenization is where you can then take a tokenized asset and leverage DeFi protocols and pools to then be able to pledge those assets. I think you can't talk about tokenization without talking about Bitcoin, without talking about NFTs, without talking about DeFi. And so I think they're all kind of different parallel paths that we're all taking right now, but ultimately they're going to converge. And the question is that going to be in the next year, 5 years, or 15?
I totally agree with your thesis that there is going to be a lot of resistance to change. There's a lot of hands in the cookie jar that enjoy all of the inefficiency that exists today in T+2 settlement, et cetera. But there will be a tipping point where there's enough client or investor demand pushing towards innovation where the incumbents, I think, are going to capitulate. They want to then the next day be ready to service these assets in a more efficient way.
Instead of focusing on the intermediary, I would basically try to focus on the function the intermediary provides. And can this new paradigm actually execute the same function in a much more efficient way is the question that we need to be asking. What I do think is that how the functions will be performed will change, but the functions would still be relevant. And definitely, right? Technology will automate away some of the functions, and some new functions might become relevant. That's how I would like to see the evolution of the value chain.
I don't think the functions that exist today in the traditional capital markets are going to disappear. And at PolySign, we preach evolution, not revolution. We're trying to work within the construct of the current capital markets because the type of investors that we're targeting, or type of clients, I should say, are institutional investors, institutional asset managers, and we're working with other institutional grade service providers. We have a proof of concept going on right now in the UK with a large global asset manager, a top 10 asset manager, who is creating a digital feeder fund for an open-ended institutional real estate fund. And they wanted to use as much as possible the current service providers that they use, one of which is a large global investment bank, top 5. And part of the reason why they want to do it is because it's a lot less resistance internally to get approvals.
What can a smart contract do gets a little overhyped. So to give that working capital example, we're going through it with potential parties involved. We got to have someone who's the paying agent. Right, even though this is going to get issued below par and redeem at par, someone's got to be on the hook for that. You can have all the nice, colorful code in the world you want, but we're going to sit there and say, which legal entity is on the hook to make sure that money's available? Well, you still got to settle trades. And if anyone who's been on this call looked at the world of cryptocurrencies, it's a mess. All right, for all these nice young kids who think they've done great stuff in cryptocurrencies, anything around settlement and cryptocurrencies, it's just BS. It's everything wrong that we've corrected over the last 40 years. You can shorten settlement times, And but you still got risk, market risk between the time you trade and the time you settle, because you're not going to settle absolutely continuously. We need to come up with a substitute function for settlement and risk management, and whether we end up doing atomic trading and settlement and trade and settle instantly, or we settle later the same day, or we settle T+1. There's a whole bunch of philosophy around that. Something needs to unite those things. Otherwise, if you look at what people are doing in the crypto markets today, you can see what happens if you don't have some commonplace. In the crypto markets, if you trade with 5 OTC brokers, you've got 5 settlements to do, even if you settle net. And I might not be able to settle with Neil because Jack didn't settle with me, and we have a mess. I think you may have a new way of doing custody where you have distributed asset custody. So looking here at Neil, 100 of his clients could go buy the same Fireblocks machine. The only thing they've got in common is that they're all sending Neil a check at the end of the quarter, at the end of the month, or a payment for using his software. But those things aren't connected. There's no one institution that's got possession and control of those assets like an ICSD or a CSD. I think that's going to evolve, and I think you'd expect to see CSDs have to think about what's the service that's then needed if you have decentralized execution venues, decentralized asset custody, and decentralized means of payment. We think that you're going to need some utility functions in the digital asset space. As I said, if you look at this trinity of things you're going to end up with: execution venues, asset custody, and means of payment. Something's got to unite them. And today, that something is ICSDs, CSDs.
So rather than having counterparty risk to a central clearing party, to a CSD, you now need to figure out and assess what is your risk to the technology or to the code or to the smart contract, which essentially is governing everything that's happening with these tokens. So I think that there is another lens to look at this from.
Software is great at executing happy day scenarios, right? So when things just fly through, software basically can scale zillion times, no problems at all. It is the unhappy day scenarios, the exception scenarios, is where you need orchestrators, the paying agents. Who do you sue if the money doesn't flow in, right?
In DeFi, theoretically, you don't really know who you're transacting with. And so to the point earlier, Rajiv, who do you sue if something goes wrong? What if the code breaks and you lose your assets? At that point, you're kind of SOL, right? I don't know how many folks in the audience have tried to execute a DeFi trade today, but it's not easy. You got to go create a MetaMask wallet. You then have to link it to a DeFi protocol. Then there's 15 different steps that need to occur. And so until that is solved and until there's a more efficient way to access those markets, I think we're not really going to see traditional FIs and institutions really jump in.
The institutions that we're talking to as well are realizing that notion of who the actual counterparty is generally a software provider without a balance sheet, not registered, not insured, and they really need those things. So while it's exciting to think about this trustless sort of world where everything is truth over trust and we're going to disintermediate the banks, institutions are not going to put hundreds of millions, let alone billions of dollars on a web browser to access a DeFi market. It's just not going to happen. And so I do think you're going to see banks come in.
Any of those marketplaces that are DeFi have got to answer 2 questions. Number 1, who's the operator? Number 2, which judge do I go and see in which country when all the smart stuff and the ever so clever code doesn't work? My assets got locked up in this smart contract and they're going around trading and I want to get out. I want to hit the stop button. The stop button didn't work.
I do think that as standardization comes along, as there's more trust being put into the technology, that we are going to ultimately see an evolution where we are disintermediating a lot of these guys. What does it mean to actually custody a digital asset? Because at the end of the day, it's ultimately the ownership of the private key. And so it's much different, and it's a much different concept from a traditional custody relationship.
I definitely think that if not all, some of the large players coming in from the digital asset ecosystem will become regulated, will basically touch the traditional securities world. will bring in some efficiencies. That's at least in my view, that's inevitable, that they will come into this market because it's simply too large for them to ignore.
So I think you're going to see a lot of the legacy service providers evolve and adapt the services that they have and ultimately become more efficient.
So I see the custodians needing to extend their offering. In a way, it's almost like being a private bank. If you're a private bank today, and we've heard this firsthand here in Switzerland, do you offer access to cryptocurrencies, yes or no? Well, one is a philosophical question, the other is an infrastructure question. If you're a custodian, if you've got a fund wants to put 2% of their assets in cryptocurrency, you got to go out and talk to the likes of Neil and say, hey, Neil, how do we do this stuff? You've got to get over the philosophical hump because you're in the service business.
You've got to basically get over the hump of looking the digital assets as just solely being crypto. You got to basically take a view of, do you think, the assets and the way they are represented are going to change in the near future? And how do you evolve your custody platforms and business? Do you really want to open yourself up to a small competition that might become much larger in the future by deciding not to support a specific type of asset representation? You need your core platforms to be able to support custody of tokenized assets. And I think that's where large custodians would be traveling to, or are already on the path of in that journey.
I think the analysis that most, if not all, the big global custodians is: do we buy, do we rent technology, or do we build it from scratch? Building it from scratch is going to take a long time, and it's really hard to do. It's hard enough to get engineers. They want to go to smaller startups where they can get equity and grow quickly. It's hard to attract the talent that it would take to build this sort of solution. And I think also the big custodial banks are not going to be first movers. They've even told us as much. They want to see demand in their face before they're actually going to move. But yet when the demand is there and the large institutions, the Millenniums and the Bridgewaters or the pensions go to them and say, hey, it's time, I want to buy some Bitcoin, what can you do for me? They need to have a solution in place. And so, licensing Fireblocks infrastructure and that stack and building around it is an option. I think there's going to be an M&A boom, which I referenced earlier, where large banks over the next 2 to 5 years will be buying specialist firms like ours to advance their effort in this place. I think you're going to see the industry adapt pretty quickly here.
My view personally is that as some of the larger traditional custodians start to get into the game, you look at a Bank of New York who's leveraging Fireblocks for their institutional custody platform, that is going to then attract a lot of these asset managers and other banks who are looking for a custodial relationship in the space.
The ability for an institutional investor to continue to do business with a known counterparty across the table with a new asset class or new service is far preferential than developing new relationships with counterparties that these big organizations just don't have any relationship or rapport with. So brand matters a lot.
The centralized crypto exchanges at the moment have an advantage, and they probably have an advantage into the medium term. They're effectively an on-ramp for a lot of investors to get into these asset classes. I think when you look at the kind of decentralized equivalents, they're not quite at that kind of stage. I'd also say that probably those centralized crypto exchanges have, apart from kind of particularly well capitally backed, they also have a growing level of trust, I think, among investors as well. So I just think that they have the edge at the moment.
If we look at the major exchanges across the globe, they don't have the infrastructure in place to be able to deal with tokenized issuances.
In the longer term, the benefits of tokenization should feed upon itself and should be a self-fulfilling prophecy, right? So if you have greater liquidity, greater transparency, smaller investments, thresholds to get in, that should do its job of attracting more investors, hence more liquidity. In the near term, the question is, how do you stock the pond, if you will? One idea that we're exploring is the issuer itself starting to generate some liquidity and providing some liquidity just to get the ball rolling. So I think there will be a definite need for sources of liquidity to create the market that will then attract other investors to come. Over time, it will take care of itself. But in the early days, we're going to need some seed capital to get this going, I think.
We do have a cold start problem in tokenization.
I think ultimately, though, you need a particular type of asset class to really take off. You need one asset class probably to kind of take off. I still think it's early days in terms of what that asset class actually is. So I think you need something that's going to prime the pump, if you like, and really kind of drive activity. And so for me, I think it's really figuring out which asset class is really going to be the one that drives this initially, at least to get it to kind of a point where it starts to scale.
I think a financial market infrastructure provider basically getting and creating a tokenized, once they go live, it could have that snowball effect. More things would be possible, and the other thing is, as settlements time compress, you would also look at newer tech to sort of give you that edge. And that could also drive the tokenization adoption.
We've been talking to the large incumbent service providers. They also see a benefit from digitization, blockchain initiatives, DLT, et cetera, around revamping their own legacy processes that are very inefficient.
If you can make the settlement part easy, then more people can participate more easily. And conceivably as well, if I look at some of the things we're doing around SDX, you can make what's new as backwards compatible as possible with the things that the banks have got. So if Rajiv is a client of, let's pick UBP in Geneva, and he wants to put 2% of his assets in crypto or wants to buy a digital bond, he doesn't want new. He just wants the new asset. He doesn't want a whole bunch of new infrastructure. They don't want to say, go and see another bank. So we have to help those banks do that and transform between the old and the new. Effectively, you're bridging between the two things. The banks have to play along. So yes, they want to continue to have their role as an intermediary. They need to take those first steps on what's a long journey. Those first steps are just a pain in the neck. But if you don't take the first few steps, you never get started. You need the banks to play along to help their customers make these marginal investments in new assets and take a time horizon that's not just the next quarter or even the next 2 years.
Global regulatory collaboration would be huge. That'd be a watershed event. And the issuers are really keen to understand that before they really lean into it.
If we want to look at what could theoretically be a catalyst for this market to really grow, is I think we missed it with Coinbase, but another maybe crypto native company that instead of going down the IPO path goes down the tokenization path. And I mean, that I could see that happening in the next couple of years, especially with the amount of retail adoption that we've seen in this space and the institutional adoption that's coming. I think it's going to take a leap of faith from some crypto native institution looking to go public and have that type of liquidity event.